Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. I've had a lot of requests or several, about talking more about when to sell a stock. I write a lot about just kind of basic valuations, usually when I might buy a stock, but I haven't done quite as many lately, especially on selling a stock. Part of that has to do with the fact that really quality businesses right now who can pass on the inflation that we've had are a little tricky to value because we don't know what inflation will be, and it seems like it's going to be higher. And because the higher quality businesses can pass that inflation on, it makes those businesses more valuable relative to where they were, say, before the inflation or in the past, because the previous, if you use historical earnings growth to kind of extrapolate out, if inflation is higher and they're able to pass that on, that will inflate their earnings growth going forward, so that they actually may be able to grow at a faster nominal rate. They might not really be growing at a faster real rate, but stock prices run on nominal. So it's a tricky time to kind of sell the relatively few quality businesses that are out there. So that's one of the reasons why I haven't had quite as much conviction in terms of selling, but I have definitely made my fair share of selling videos. So in terms of the reasons to sell, well, there are a lot of reasons to potentially sell. So this video is going to focus on overvaluation and only of quality businesses, right? So I'm going to assume a person bought a quality business. I have Nike up on here, Nike, and we're also going to look at Estee Lauder, who are businesses that have had a long history of earnings growth and growing and making money for shareholders. But I have made sell videos on them both here on the channel back in 2021, and I've also written sell articles on them. So they're quality businesses, but because of the valuation relative to their likely future earnings, I was confident enough that they were so overvalued that I could really confidently come out and say, even though these businesses have been really great in the past, the stocks are too expensive. So this video is going to explain some of the main factors that go into like an overvaluation sell, when to sell. So I made my first Nike video on January 3rd, 2021. So one thing to remember is that when you do a valuation, an earnings valuation analysis, like a fundamental analysis, you're projecting out these earnings into the future. Well, the correlation between stock price and earnings changes increases over time, but it doesn't necessarily correlate very much over just definitely not like a year or two. You really need to get into that. With stocks like these, often it takes 5 or 10 years in the future before the market fully realizes, okay, these businesses aren't growing as fast and they aren't likely to grow as fast as they have in the past. And then that will mean that people will pay less for the stocks ultimately, and the prices will come down, especially if they're overvalued. So just because you sell a stock based on valuation and it keeps going up doesn't mean that you made a mistake selling it, because really when you're using an earnings-based technique, it's really like 5 years into the future that you're trying to predict. You can't really predict what will happen quarter to quarter, despite what the entire financial industry tries to make people think. So I'll just get into use Nike as an example. So before I made this, by the way, we'll look at the sell. Let's see, 1/3/21, and you can just search this on my channel. Just search the ticker, or search probably the ticker, and it will pull up that old video, and you can watch it, and you can watch all my reasoning behind that in there. Okay, so you can go back and actually look at the numbers. I'm not going to get into necessarily the specific numbers. So at that point, it was a 50 PE. And so that was a sell video, and now it's down almost 30%. And the market, I believe, since 2021 is probably up. Yeah, it's probably up since then. So definitely a good call, it appears. But I also wrote an article on Seeking Alpha in September, another sell article in September of 2019. And what I want to show now, we had COVID here, which kind of got everything a little wacky for a while. But again, the fundamentals, I think it was right around here. At one point, now the stock is up slightly since then, but the market and inflation's up like 25-30%. So that's really a loss. And then the market is up 75 or 100% since then. So on a relative basis, even if you sold back then, it would have been a good sell, even though it hasn't lost a ton of money since then. In real terms, it has. And the other thing that I want to point out is, okay, so between then and the peak, I want to say it was this week in September. At one point after, I'm just assuming a person would have sold. I didn't own this one beforehand, so the stock price rose 100% first. So the call was correct in my view, and a person would have been better off, holding, CDs or whatever, or treasuries over this time. And they definitely would have been better off just buying like the S&P 500 index relative to holding Nike. But in the meantime, before it took the market a while to realize what was going on, the stock did double, right? So you look kind of dumb, or I look dumb at first. But eventually these earnings kind of act like gravity. And when they don't go up to justify this, when the earnings are just kind of flat, over time, eventually, the market will someday revert back to the earnings trend. And with these really strongly branded companies like Nike, that everybody knows, it can take a while. But you don't know when you own the people that were buying up here or that held up here. They didn't know it was going to lose more. Well, let's just see what it lost off the peak. So they didn't know that it was going to lose 50% in less than a year, right? So, but even back in 2019, we knew that the danger of having low or to no returns or having these negative returns was high. The probability of that was high. And I think the forward returns, I forget exactly what they were back here, but at a 50 PE, I mean, let's take a look at. So if I was doing that analysis then, before COVID, I probably would have gone like pre-pandemic. And then this, I'm just going to use the fast graphs because it's convenient. The fast graphs earnings growth right here, but which was like 10%, although the most recent one was not. But they also bought back a lot of stock. So this is probably was actually much lower than that. Maybe not much lower, but a little bit lower. More like 7-8% was the actual earnings growth. So it was trading at a 30 plus PE, I think, at that time. Let's go one more year into the future, so we can capture their year cutoffs are a little weird. So yeah, because we were September, so we were up in here. We were at a 40 PE, and what we had was actually during this time, we hadn't quite had that 6% growth, but they were on their way down. They're expected to. So yeah, let's figure like 7% earnings growth over this period, and they're trading at a 40 PE. Well, if we just use a basic PEG ratio, and I do all the calculations for the CAGRs and stuff, and you can watch that in the videos, but a 40 PE should probably have like at least 20% earnings growth, it's maybe triple the earnings growth of what they actually had in order to justify that. And then you would have to expect that they could keep growing at like over 20% for the next at least 10 years to justify a 40 PE. So that's what you would have needed, and what you had was 7% and flat and falling earnings. So it was a pretty simple, easy setup. Now, sometimes, an unexpected thing, COVID definitely caused a boom in the earnings, the COVID stimulus anyway. But the basic setup was, this is a very high PE ratio, relatively mediocre growth is what I would call it. It wasn't bad, but it wasn't great. Like normally a 7% growth stock should just, if it's a big, well-known brand like Nike, should trade at like a 15 PE, 16, right in there. And instead it was almost triple that, right? So that means that the forward returns are likely to be pretty low. And they have been. They've been almost flat. In real terms, they've been negative since the 2019, and way negative since I made my video. So one of the things to also think about is, because you can sell like a really fast growth business that gets overvalued too soon. So I would caution against that a little bit. But if you think about Nike and you think about their total addressable market, well, it's pretty much been addressed. They're in like every sport. They're a worldwide brand. Everybody knows their shoes. They're really in a position where it's more maintaining their brand, being able to pass on inflation that goes on, consistently. And that's kind of the situation that they were in. So their market's pretty much full. And that means that a 7% growth rate is what we should expect. We shouldn't, even if they have a year where they grow 20%, which maybe they did at some point. Yeah. So in 2015, they grew 25%. We probably should have been a little skeptical that would be able to be maintained. You can see the market really wasn't. It traded at a 30 PE, but at least you can kind of see why they had this big spurting growth. And that's why going year by year, or especially quarter by quarter, doesn't tell you anything really about the long-term trend and what's likely to happen. So the other thing is you think about that when things really start declining as they are now, think about competition. So these guys have Hoka brand, they have On shoes now that are really pushing. Adidas has always been a competitor. And so, but you have these newer brands that are coming in, and Nike is a very big company. It's a $150 billion company right now. So they have a lot of market share, and it's theirs to basically lose. It's really hard for them to gain. And it just stacks the table against them if you're banking on this fast growth going forward. So there becomes a point in time where, as an investor, doesn't mean there's anything wrong with Nike. It just means you should not be paying. So if you think of a PE ratio as how long it takes the company to pay you back with their earnings, it shouldn't, assuming they don't grow, which really they haven't had much growth since this time period. If you calculate this out, actually, let me just look at it. I have it in my spreadsheet. So yeah, so 6% growth is all they're growing. But if they didn't grow at all and they traded a 40 PE, it takes you 40 years to make your money back. That's how to think about it. So, yeah, just mediocre growth, and that growth is getting a little bit even more threatened by competition. Okay, and so that's what we often see with these companies. So the other one, and I also made a video for these guys, and I wrote an article later on, is Estee Lauder. This is much more negative, but this is what can happen when things kind of just when competition like picks up. So growth, if you go from like 2015, even up before growth started falling, you really just had kind of okay growth, right? Considering that, again, we're talking 30 PE ratios, right? Very similar to Nike in terms of value that was placed on the brand. Now, granted, they did have a couple years of good growth, but they also had a negative growth year here, and then COVID hit. And once again, if you look at this valuation, when did I make this article? 117.21. Okay. So 117, okay, 115 is probably the closest we're going to get. A 46 PE. Now, granted, earnings were recovering at this time from COVID a little bit, so that might have been a little bit more like a 35 PE when it was all said and done. But very, very big PE. And if you go back and just look at like the growth rate, that's like 10% earnings growth during this time. So you have we'll call it 30 to 40 PE. That's a PEG ratio of 3 to 4, very high. And everything basically would have had to go right, and then if it did, you would just do okay over the long term, right? So if you look at the return since I made that video, at first the stock kept going up. It went up 50% basically since then. So again, I looked dumb for a little bit, but as we know, it takes time for a fundamental valuation to work. Now what happened was their competition, if you think of all these smaller beauty companies, like e.l.f. is probably the most well-known, start taking away their business. Well, they're a very small company, but again, we have a 50 billion, and at the time I wrote that, they were twice as big. So they were a $100 billion company, which is huge. And pretty much they have filled up their growth. Some of this decline has come from China, and I don't think that's Estee Lauder's fault, but it's one of the dangers of being a big company. We kind of see it, whenever if you think of McDonald's is all around the world, if people in certain places decide they don't want McDonald's for whatever reason, it's not just what's happening domestically that hurts their stock. They've already grown into that area where if you have a smaller business, they still have that growth ahead of them. So if you're going to pay a 50 PE, you might as well buy the small one who actually has room to grow. This was just a totally ridiculous valuation. I mean, it's 5 times higher than it should have been, right? That means it needs to fall 80% to become reasonably priced. So that was assuming earnings didn't fall as much as they have. But from there down to the bottom, they fell 70%, right? Like, eventually it happens, but you don't know when that's going to happen. So when you own a business like this, you want to be aware of that if you sell it a 30 PE when the growth doesn't support it, the idea is you can take your money and go put it someplace else where it's either A, less likely to lose value, or B, hopefully more likely to gain value. There's not always opportunities in the market. A lot of times stocks get overvalued at the same time, so you might have to put it in cash for a while and just wait until something comes down to a better level. So it also, it points out that even though the stock has fallen 70% or 65% now, it still trades at a 50 PE, right? I mean, there's still investors that think its earnings are going to come back. And they might, but it's much, much harder, for these guys to regain market share that's being taken by smaller, more nimble companies. So I would be skeptical I wrote an article after it had fallen that basically said, it will probably never see these all-time highs again. I mean, unless we have like a bunch of inflation, it's like 30 years later or something. So, and that has been proven so far to likely be the case. So yeah, those are the times where it just becomes really obvious that something's overvalued. I also made videos on Disney, which is down like who knows how much, and PayPal, which I'm actually long now. I don't know why I can't. Maybe I'll just type it in. There we go. And PayPal, which I'm already... So I made a video, I don't know what the date is, but it was during that same period in January of 2021. So back in... Maybe it was February. It was right near the peak here. So, and look, it's a 68 PE. At least they had 20% earnings growth going. But that's a lot to pay. Everything has to go right. So they had one little blip where earnings fell 10% one year. And when you pay that much, or you hold when it's that overvalued, then the danger is one little blip like this where earnings fall and the stock price doesn't fall 10%. The stock price falls 75% because everybody was expecting 20% earnings growth every year for 20 years, which is like what a 60 PE suggests. And so when they have a year where there's negative earnings growth, then, kiss it goodbye. The stock almost always goes down. So, and then I bought it. I made a video on that too. I bought it somewhere down, I think in the fall here, like winter, fall. It wasn't at the bottom. It was around 60-ish, I think. So I'm hoping that it's kind of that overreaction has gotten done. The company gets some kind of growth going. I don't know what the PE was here, like 12, I think, or so when I bought it. So that's pretty low at least. And we'll see what happens. But at least the odds are kind of in the favor that if they can pull a little bit earnings growth, they'll come back. But that's a different subject. Disney, we'll look at one more that I made a video on, a sell video, right? So this was similar too. Now earnings had already fallen, and the bet here was that they were going to come back, sort of, but it was mostly on streaming. So again, that would have been made in January 2021. 80 PE, probably would have recovered some of it, but this whole bet on streaming, when they have more nimble competition from Netflix and everybody else, HBO, they just weren't able to do it. So they're still down 30% from there, roughly. Although it looks like they're starting to try to come back here a little bit. So those are the really obvious overvaluations. But actually, Disney was probably overvalued even back in 2015. If you look, well, it was about 2015 when their earnings growth stopped, kind of. So they're paying a 20 PE. And they could tell the cable business was being slowly eroded. So that was starting to kind of show up. And so the future, you could kind of see that. In 2018 was a tax cut year, so that kind of explains that. Basically, earnings flattened, and they were just trying to maintain, but the market was, willing to pay a 20 PE for flat earnings, which again isn't very flat and probably going to decline when it comes to cable, like ESPN and cable and all that. So, when earnings growth doesn't support the really high PE ratios, and you think and a business is fully mature, basically, when you talk about these businesses, they aren't immature businesses that have a bunch of market they can go out and get. Really, they have to invent a new type of market, which Disney actually kind of did back in the 90s with VHS tapes of their old movies. They're basically able to take their property and find a new way to monetize it. And so those things do happen, from time to time. But generally speaking, the market, once they get big enough, their market's filled, and it's all about defending from competition. And when you see earnings growth slow, competition taking maybe some market share from streaming services, in this case, then and the valuation hasn't adjusted for that yet, which often it takes a long time for these businesses to get that valuation adjustment. They most of them are still trading at premium valuations given what's actually happened. Because people know the brands and they're just used to it. Some people don't want to sell for tax reasons if they've held it for 30 years. They don't want to pay that tax bill, so they'll just hold on to it. So you can see these just decades of stagnation. I mean, if you look at Disney here to here, that's totally stagnation for 10 years. And really, I picked a little bit of a peak there, but I mean, if you just kind of pick one even partially there, and I didn't point it to the bottom, you just had 10 years worth of lost earnings compared to if you bought Netflix, right? Netflix stock, which was actually growing and taking their business, basically. So that's one reason to sell when a stock is overvalued. It's because a quality stock is overvalued, that you already own it. And when it gets really extreme like that, there's always individual decisions that go into it, because you might have to find someplace else to try to put the money. So you might want to really make sure that they're really overvalued. But I made videos in all these cases because it looked to me like they really were overvalued, and the odds of getting really good returns, even compared to cash or treasuries or something, was probably low, and definitely low compared to just the market average. So that's one thing everybody can kind of look for. And if you go search those videos on my channel for these, and then watch them, and I'll go into the actual numbers and show you how it all works in those. All right, thanks for watching. Let me know if you found this useful. I'm going to put this in the playlist for new investors to watch. And if you like fast graphs, it's very useful for this type of analysis. I have a 25% off link, affiliate link down in the description, and then a code there that you can use to get 20. I think it's 25% off. Okay, thanks everybody. See you later.